Hi everyone, welcome back to the channel. Today we have Chi Keng here. This is the first time we collaborate, so I'm very excited and very happy. Thanks for coming.
Yeah, I'm happy to be here.
So for those who, I think most of my audience will know about you because you also show up on my channel before. Okay. But just a quick introduction just to start up.
Sure. My name is Chi Keng. So I do run a very small YouTube channel. Then I do talk a little bit more about Alibaba. I have a focus because most of my portfolio currently is concentrated in just one counter. And yeah, I've been getting some publicity recently because Alibaba share price essentially tanked till $70. And my nickname is Tay Falling Knife Chi Keng because Falling Knife is my middle name. So yeah, just a way to start out the introduction.
Yeah. Okay, that's interesting.
Right.
Okay, I just want to know, like, it's quite curious, right? Because when I watch your YouTube, your channel, they are all about Alibaba contents, right? So I just want to know, like, how do you stumble into these companies? Do you like actually run through the screener and then find that this company interesting, or is it because like you watch some of the Jack Ma's video and become so obsessed about Alibaba? Okay. Can you tell us the origin story?
So I think initially we need to go back like when I first started out investing. I think I started investing maybe in my second year of army. I started dabbling in Singapore stocks. So I was buying all your big names like your DBS, your Sembcorp Industry, your Keppel Corp. So those back in 2017, 2018, those are like blue chip companies that will probably not fall because I have full faith and full trust in our government. They're definitely going to bail them out. Even in COVID-19, you see that the government also took huge measures to help out these companies, even like SIA, for example. So then after that, after 2020, stock market reacted accordingly and we had a huge valuation haircut in the US market. So I was thinking, hey, I'm still so young. I wanted to venture into some space with greater volatility and greater upside appreciation. So I started venturing into US market specifically. So I bought also your big tech company. So it seems like I have an affinity with a lot of all this. I don't really like to go into this small cap penny stocks, etc. I like to buy businesses with a proven track record and also businesses that are big and you can at least understand what's the asset value, you can see what's the cash flow and whether they have debts or not. So that's probably my style. And I bought into FANG companies like Apple, Microsoft, JP Morgan, Goldman Sachs, those kind of companies. Then after that, why did I pivoted over to Chinese tech? Of course, I'm a user of both Taobao and Lazada. So Alibaba is actually a very familiar brand to myself because I'm using their products. And more importantly, I also understand from the perspective that as a Singaporean, our culture is very entrenched. We have both Eastern and Western culture. But I think personally for my family, because we are more Chinese speaking, so I do have a greater exposure to a lot of all those like Confucius values, China developments, etc. Then more specifically about the business, if you were to ask any Chinese national, which is probably from China, that is in Singapore, your scholars, your colleagues, etc. They have two apps in their phone. One is WeChat, the other one will be from Alibaba, either Alipay or maybe Taobao or whatever, Lazada if they're in Singapore. So it proves the scale and the influence that they have in everyone's life. And even you on my phone now, I have the two apps as well, Lazada and Taobao. So this was how I understood the company at first glance. Then how did I move on from buying US big tech to going into Chinese big tech, right? Was really this idea of valuation. So I wouldn't consider myself value, growth investor, those kind. I don't identify with any of those values. I identify based on a set of principles. And so when I bought Apple at 100, 110, I thought it was cheap because it was I wouldn't say it's cheap, but it's probably on the lower end of a fairly valued spectrum. So after it appreciated the 140, 150, I exited my position because I thought, hey, I'm not very comfortable with this valuation and I don't think that the multiple is going to continue expanding. So I started on a hunt to go and continue on to look into other aspects, and that like everybody said, there's 8,000 over companies out there. Why do I need to get stuck, or why do I have to pledge allegiance to one? So then I started pivoting and I see, hey, just nice, we have the China government trying to crack down on these companies, then why not? So I went on to explore. I went on to see some of the valuations. I did my own DCF, understand the business on a much deeper, I had a deeper appreciation of the businesses. And I thought that, hey, this is on a risk-reward perspective, it looks interesting, and that's how I started building. And don't worry, I didn't exit initially I didn't exit all my US position and then just straight away buy into Alibaba. It was really a phased approach. So I first started buying in at 240, 250, then I started selling more, buying in, selling more, buying in. And then till today, because it crashed for 1 year already, so my portfolio inevitably become 85 to 90% Alibaba because of this so-called rebalancing. But of course I know it's extremely risky. For people that that cannot take it, or for those of you who are not interested in investing in specific companies, right, just buy the index and you have better things to do in life. So that's just how I came about into buying into Alibaba until today.
So actually, you bought it before the crackdown started and before the price peak, or
no,
after?
I bought it after. So
okay.
it peaked at 300, right, or 310 if I'm not wrong. So I actually bought it at I wouldn't say at a very low valuation. So when it started retracting down to 240, 250, that was my first position. But I bought very little. I bought like what, 4 shares, like $1,000 USD. But today, don't tell me about the price anymore. I don't even check my portfolio today. Yeah. So that's how it went.
Yeah, okay.
Right.
Yeah, so I just want to understand, because we all know that in China, right, especially in China tech companies, this is a landscape that is very competitive, right? So it's not just Alibaba, there are companies like Tencent, JD, Meituan, Pinduoduo, these companies, they are all competing for the Chinese market, which is still growing. That's the good thing.
Right.
But let's say, come back to your channel and your own portfolio, right? You are just focusing on Alibaba.
Right.
And I don't think you invested in, let's say, other companies, right?
Okay.
So I just want to understand your view, right? Have you actually looked at all these Chinese tech companies as well? And then what quality that Alibaba has that make you so concentrated into this single position?
I think it's a must when we are investing. I think we need to always look at the adjacent industries or even adjacent companies. So I think the big three in Alibaba, the big three in China, the e-commerce, Jingdong, Pinduoduo, and Alibaba. When I look through all of them, I think my values, or in terms of how I allocate my capital, Alibaba really resonated more because they really focus more on asset light. Even though, we can discuss about some of the developments on why are there more capex and increasing value proposition. But initially, what attracted me to Alibaba most, right, was because I really look into all the different Chinese tech companies. I don't like some of the business models. So one example is Meituan. So I don't really like Meituan because when I look at across the entire globe, right, everyone in the food delivery or in that space, right, most of them are all profit losing. And you look at your Uber, your Grab, your DoorDash, all of them, it doesn't favor me. I feel uncomfortable with those kind of business model. So actually the two biggest that I was fighting when I was doing my own evaluation and looking through the companies, right, was really Tencent and Alibaba. Number one, they had strong track record. Whatever industry they're in, they're probably one of the market leaders. So that's one. You have to give it to the execution team and the management team. So there's this execution premium. Number two, like I said, in the phone itself, the apps, influence and ubiquitousness, it's the two apps. They are the two dragons that represent China today. So of course, I'm not trying to belittle the rest of the tech companies, but Baidu has a pretty bad track record. They were the Google of China, and then now they're trying to pivot into autonomous driving. They're coming their Apollo arm or something, if I'm not wrong. Then that was why it really voices down back to these two companies. So now you ask me in terms of allocation, it's true. I think I started allocating a lot to Alibaba, but recently, actually back in October last year, I started a monthly DCA strategy. I started buying KWeb. So my KWeb position, KWeb's holdings, the biggest holding was Tencent. So I think it's around 10 to 12% is in Tencent. So I do have exposure in the entire Chinese tech sector by and large. But if you were to compare in terms of sizing, of course, I just started KWeb not too long ago. So it takes time to start building up that position. But that was really my own thought process thereafter. Tencent, why did I not invest in the business, or why did I not really allocate more money into Tencent, right? I think long story short, I don't really understand the business in a very core, very, very plain level. So if you were to ask me what does Alibaba want to do, or what do they want to achieve, they want to help build the backbone of China's economy, which is to help small, medium enterprises. So you look at the e-commerce arm, the cloud computing arm, it's all targeted as SMEs. So I understand where the direction is going. But then you ask me what Tencent is doing. Is it a social media company? Is it a gaming company? Is it an investment arm company? I don't know. And even though they prove good track record, but I don't know how are they going to allocate capital in the near future. Or at least they can keep investing in the next Tesla. Then everybody hot big. That's good for all the shareholders. But because I can't identify or I can't align myself to the management team and their vision, right? If you were to look into, if you to just Google, or you can edit in what's Tencent's mission and vision, right? I think they just want to do everything software related. And it's not, how do I put it? It's not very clear, and I think a very simple guiding principle is if I can't explain to myself or a kid in 1 or 2 minutes, then I probably don't touch the company, despite how good the ROIC is, despite what kind of fundamental metric they are looking at. If I can't explain, I can't convince myself, then I won't touch it. So that's the easy explanation to everything.
Just not enough focus for you as relative to Alibaba's, right?
Right.
So So I saw I watched your video with Darren's. Like you try to like clear this misconception like Amazon and Alibaba is the same. Actually, they are not the same. Their business model is totally different. But the one that is similar to Amazon is actually JD.com, right? So they started out not as a SME, but they do it, a lot of all this logistics, they do it in-house, right?
Correct.
So I think in terms of business model, let's comparing Alibaba and JD. JD, they spend on logistics, and now they actually kind of like went through the times when the margin is very low, because now we already see the scale already built out, right? And now their margin actually improving. But compare it with Alibaba, is that Alibaba, they started out with advertising, which is high margin, and now they have to pivot into a business model that is similar to JD, which is high capex, right? That's why there's this profit margin that affected, right? So just want to understand, just now you explained Tencent, you talk about Meituan, what about JD
versus Alibaba. Okay, so I think I do fundamentally agree in this trajectory, because numbers don't lie. We can look at in terms of compression, but I think I would just like to make a distinction, right? It's true. I think in the DNA of Alibaba today, Alibaba actually initially when they come out, they just want to be a platform. They just want to take rates. They want to do advertisement. They don't want to help you do fulfillments and buy. They do have warehouses from time to time, but it's not as extensive, and they don't go that mile ahead to really copy out Amazon's or JD's business model. But that being said, I think I'm not too sure whether some of you have heard before of this idea called Pareto principle. So it's the 80-20 rule, right? So most of your 80% of your outcome is done by 20% of the effort. So I think likewise in Alibaba's current strategy, right, at least in the near term, they are just trying to put in least amount of effort to get the most amount of to reap the most amount of outcome. So in this case, sure, they are investing a lot in their warehouses, technology, AI. They try to integrate it into their warehouse and to make it faster. They want to reduce. All these are part of improving the customer experience. But personally, I don't think that they have a full interest in saying, I want to go all out and say I want to take over. I want to make sure that I'm the fastest in the space. I want to be the cheapest in the space. No, I don't think they have that perspective. They really just want to. In a way, they are trying to in a moat digging exercise. So they are trying to expand their value proposition, which was also why they dig into fresh produce. They start going to groceries. They start going to third-tier cities. But then you also realize that after they expand to the third-tier cities, it seems like they're slowing their growth now. They say that, okay, stop. I don't need so many people anymore. So I hit a certain threshold. I'm fine with it. I'm okay. So Pinduoduo now it's experiencing a significant slowdown. I think recently in the quarter they only grew 3%. In such a fast-growing space, they only grew 3%. So it really shows that the heat Alibaba is posing into it caused enough pressure to the rest of them. So which is why that is my general feel and understanding of Alibaba's perspective. So they go in, they try to get as much as they can, and they are not there to really push the limits and be better than everyone else. So that's the first part. Then on second part, I'm talking about JD versus Alibaba, right? The idea is I really took a lot of reference points from Amazon. So Amazon's e-commerce business is actually lower than Alibaba, by the way. For those of you who don't know, I think Alibaba's GMV is 1.5 times more than Amazon, even though Amazon is a global player. Everywhere, everyone uses Amazon. Europe, even Singapore, I have friends that uses Amazon. I don't know why, but Taobao is a lot cheaper. But anyway, if you were to really look into the fundamentals of Amazon's business, right, a lot of their margins are from AWS. They're reaping a lot of cash flow from their cloud computing arm. The e-commerce arm is basically just a aggregator. So they don't come here to earn money. They're just here with Prime, of course, Prime subscription, the subscription model. But even Prime itself is not as lucrative as the Amazon's business. But the more important factor here is data. So they get a lot of data. They know a lot of data points and how they're going to plot you as a consumer and stuff like that. So a lot of the e-commerce business is to harvest data to feed back into the rest of the arms or the rest of the initiatives that they have, and even investing into other initiatives. So that's what I understand about Amazon's business. But for JD today, it's very sad because they only have the e-commerce business. Now they need to look into how they're going to expand the margins, the profits and stuff. Because fundamentally, I believe that e-commerce is a tool, but it's not the end goal itself. Because I really feel like there is a classic example, which is Amazon. And now Alibaba is also venturing into cloud. So it feels like it's a classic playbook where everybody harvests data from their e-commerce arm. If you can get a profit, good for you. Like Alibaba, they actually harvested a lot of profit and free cash flow, which also until today I don't understand how. Because I think it's really in their DNA to be asset-light, to be just that platform, exploit network effect and stuff like that. So now they realize that there's heat over here. More and more people are plowing in, and JD or Pintoto, even Kuaishou, TikTok, everybody's coming into e-commerce. So then they realized that they need to pivot, and they pivoted early. E-commerce, they started quite early on, and now they're trying to scale up and increase their exposure over there. So that's just my understanding of Alibaba versus JD today.
Hello, we are back here again. Just now, heavy rain, so we have to run. We shift location a bit. I hope you like this different background here. So let's come back to our discussion. Just now we talked about JD, right? Comparison with Alibaba. So I think that's a good discussion. Now I just want to come back to the local markets, because initially you said before you venture out into China, you invest into Singapore stock market, right? Actually, what's your view with regards to Singapore stock market? Is this good place to invest right now?
Right. Actually, I think in every single different markets, right, there are always opportunities elsewhere. As long as you have the ability and you have that skill set to go and find undervalued companies, why you think they're undervalued, and why do you think they are able to outperform and let you appreciate the upside. So personally, I don't have any investments in Singapore now. I think I sold out everything already. But my dad is an avid investor in the Singapore market, so he's still actively investing in Singapore only. So he has no US, China, Hong Kong exposure. But personally, now I have more US and Hong Kong exposure. I think likewise, if you were to really just monitor the index, right, STI literally trades sideways for quite some time now. Even I think the Nikkei index, which is Japan's index, also traded sideways. They haven't achieved back to their all-time high. So likewise, I think especially for the Singapore market, it's better for people with different risk profile. So especially for people that don't really like to experience high amount of volatility, the Singapore market is safer in that way because it's not as volatile. But also on the same note, it doesn't have so much liquidity. So there are limited liquidity, and companies are usually only your big companies that you always know. So of course, I understand there are smaller caps, and people do invest and try to find 50 cents to a dollar, but that's not really my investing style. So I really like to explore more outwards and really look at a competitive advantage, how they win their competitors, and those much more bigger industries with larger tailwinds in that sense. Singapore companies, Singapore market, it's a little bit like Magic Cup, It's like a fish that is struggling, but I'm sure that you are able to find opportunities there as well. But might not be suitable for what I'm looking for as an investor now. So that's why I'm not personally invested in Singapore now.
If I look at the Singapore, let's say STI, right? If you look at the breakdown of the companies, I think in terms of sector exposure, it's very different compared to, let's say, US and Hong Kong, China, right? Where they have much higher technology sectors, right? But in Singapore, I think the largest one would be bank, financial industry. Let's say 3 banks plus SGX is already like huge proportion, right? Then the second one is REITs. So I just want to go into a bit details. Let's say for financials, right? I think one of the common, common reasons that people say probably don't allocate too much into Singapore is because financial industry, we're talking about banks, right? They will be prone to disruption by all this fintech, right? So what's your take on this?
Actually, I do have a very slightly different take on this kind of fintech industry and personally, I am in finance, so I do follow some of the developments in terms of like all your buzzwords, right? You have your blockchain, you have your Web3, you have your decentralization, your DeFi, your decentralized finance. That being said, I think on the ground, the consensus now is still it's very costly. The implementation is still very iffy, even though they are there to solve traditional finance problems. Like a lot of your traditional banking needs and solutions are not very customized, and there are a lot of deadweight in a way where there's a lot of costs, there's a lot of middlemen and stuff like that. But that being said, in terms of implementation of all this new technology, right? You need a new unicorn to come out with a new revolutionary process to help disrupt the entire banking sector. But it's not easy because finance, touching about money, it's a very sensitive topic. There's a lot of compliance, a lot of all this fintech industry, even though you say a lot of like disruption, right? Those disruption you only see in the United States, you see in the West, because they're a lot more liberal in terms of their thinking and embracing technology. I think in Singapore, the government do have a very tight control. So on how, of course, there are a lot of chatters and rumors saying that, Ant Financials is coming in, C Money is coming in, Grab is coming in. They're going to disrupt all your 3 banks, and your 3 banks are sitting duck. I don't think so. I think there is still a very huge curve for them to essentially overcome, and the government is just one part of the equation.
Yeah.
I think the banks are also not sitting there and waiting for you to disrupt them. They're also taking on a lot of new initiatives as well.
Yeah.
So at least in the next 5 to 10 years, I don't think so. Maybe in the future, we don't know, but at least in the short to medium term, I don't think all this new finance jargons and new finance innovations is able to take us by a storm and all your banks is out of business. I fundamentally don't think so.
So your stand is that yes, disruption, there will be disruption in other parts of the world, but let's say come back to Singapore, the 3 banks will still be standing strong, and they could have their own fintech in-house that can actually fight back also,
actually,
right?
there are. For those of you who actually do follow them, I think DBS is actually one of those pioneers in innovation in terms of being one of the best digital bank in the world. And they actually embrace a lot of data collection, data technology, how they analyze data and stuff like that. So that's one. I think to answer your question simply, at least in the short to medium term, I really don't think there really needs to be a lot of innovation because the banks are not doing, they're not sitting down there and doing nothing. So in terms of like a dividend plays, the strength of the balance sheet, all the different strength of the businesses, I think it's still largely intact. And especially when you essentially have the stamp of approval from the government. I don't think they're going anywhere anytime soon. But that's a very dangerous mindset to have, that saying that, oh, I invest in this business because the government supports it. I think that's not how you want to invest. But particularly, I believe that a lot of investors have different financial objectives and they have different things that they want to achieve in life. So if investing into STI, investing into banks or even REITs, for example, you need a dividend yield, you want to supplement your retirement income, etc. I can understand and I can see why people are invested in Singapore blue chip companies. But for me, it's not probably not at this current life stage.
Actually, I just want to touch on the REITs for a while because you know, for local Singapore investors, right, among let's say STI or even bank stocks, right, there will be REITs investment, which is also quite popular. And you are very huge bulls on Alibaba. You see that all this e-commerce is coming. And REITs, right, if you look at their where's the source of their revenues, still come back to like I think the grocery or all this commerce, right, will still be a huge part. If let's say the e-commerce penetration become much higher, it will disrupt REITs also, right? So let's say talking to investor into REITs, right? I mean investor, do you think that this is a good idea to continue into like investing into REITs, or do you see like huge disruption in the next, let's say, 5 to 10 years?
Actually, no. I think REITs is still, it definitely plays a role. It has a role to play in a portfolio in terms of hedging, in terms of, because you're investing in REITs because you want property exposure, right? You want rental income, you want steady dividends and stuff like that. So you can do whatever you want with all your high growth plays. You want to buy Palantir, Tesla, those people growing 50, 60%. Yeah, sure, go ahead. But in terms of a portfolio management perspective, I think REITs still play a very important role. And this asset class is not going to go anywhere anytime soon. So personally, back to how I look at it, if I want to position my portfolio or someone that is probably in the 20s, it's good maybe to have a small allocation, but really don't focus too much in terms of I want to see dividends, I want to see money back into my brokerage account or money. Because at the end of the day, don't forget, when they give out dividends means that this cash flow or this amount of money cannot be reinvested back into the business. So they cannot go out and acquire more property, more land to yield more returns. So in this case, it's always you always have to look at it from a risk-reward point of view and what's the cost-benefit. So when I give out money, essentially either I'm drawing down my balance sheet or I'm reducing my cash flow. So those are the pros and cons that you have to weigh on your own. And in terms of portfolio diversification, the textbook answer, of course, is to have a proper allocation and don't go crazy in YOLOing into one company like I do. But anyway, I think because I can still take that amount of risk, that's how I essentially adjust the risk on my own individual level. But of course, there are a lot of concerns saying that, increasing interest rate environment, how REITs are going to be affected. Your expenditure and or your interest expenses are going to increase exponentially because the prediction now is like 1.75, 2% by the end of the year. Next year might even increase to 3%. I don't know what the projections are, but the issue is, in this case, you look at it, maybe in Singapore's market, banks might be a better opportunity compared to REITs. But that being said, of course, understand the company, know the fundamentals, make sure you don't overpay and know the valuation of the company you're buying into. And then just wait it out. I think patience do pay in the stock market.
Okay. I think that's a good point.
Okay,
let us shift gear a little bit. I just want to touch on a little bit on your, let's say, your investment philosophy. So you seems to be have very unique thoughts on different investment, not just Alibaba's, right?
Right.
Including other investment and also other business model. I just want to understand like how do you actually develop all these like your own investment philosophy?
Right.
Like throughout the journey, right? Actually, is there any investor or anyone that influenced your thinking, your philosophy?
Right. Yeah. Actually, I think it's very cliche, right? A lot of people say, oh, Peter Lynch is my idol, Warren Buffett is my idol, or Charlie Munger Gogo is my idol. I think, of course, everybody have a different school of thought and different views. Actually, there are many roads that lead to Rome.
Yeah.
All of us just at the end of the day want to achieve financial independence, or when we invest, we want to express our worldview, right? So we just want to know, we want to buy the winning companies, and at the end of the day, we want to win money. Then the end goal is to get money and to grow your portfolio. So personally, I think that there are a lot of people that influence my thinking. Reading all the Western literatures, even your traditional finance books, and even for those of you, I know some of you who are trained in finance, you might even find Professor Damodaran. He might be boring to some, but to me, he's extremely interesting because every time his new video is up, I find new insights and I look at things from a different perspective. So that's one in the academic realm. Then in your normal investing realm, your standard Warren Buffett, Charlie Munger. I think the most impactful one really came down about economic mode.
Yep.
So we understand that the strength of the business, there are different tiers. So we see that today I'm investing in Facebook, right? I do have a small position in Facebook. People are saying that yes, it's true. Facebook's economic mode might be arguably weaker than Google, Apple, Amazon. It's true because it's true that once Apple or Google flipped the switch, okay, Facebook got affected. Top line, 10 billion revenue affected.
Yep.
But that being said, the second part of the equation people always forget is valuation also matters.
Yep.
You need to buy into sure, people say buy great companies at a good valuation. Last time Warren Buffett, Seagull investing is he buy even good companies, don't need to be great, but at a wonderful valuation. To me, I think it works hand in hand. The percentage on how you allocate, it's an art more than a science. So there is no proper allocation saying that I must buy the best business. Objectively speaking, if we can come to an objective metric, if it's the best business, I'm not going to pay $20 trillion for the company today. It doesn't make sense. So there is always that lever that you have to risk adjust on your own. The most important thing is to really do your own research, understand your own portfolio and your own risk profile, and then look at the company that you're looking into. You think that it's a good enough economic mode, and then you think it's a good enough price to pay. You think there's a multiple expansion, you think there's upside to be reaped, then sure, why enter the position and size your position accordingly.
Yeah.
So that's my simple framework and philosophy in how I look at different investments.
Yeah.
So I don't have to buy objectively the best company in the world. I don't even think there is a best company in the world.
Yeah.
Everybody that owns any company will say that theirs is the best. So we can't say which is the best.
Yeah.
So we just need to make sure that both sides of the equation we need to balance properly.
Yeah.
And I think one of the more important role models is my dad, because my dad invested quite early on. He actually imparted a lot of his stories, his anecdotes. Especially I think the 2008 crisis also plant quite a lot of seeds in my brain about margins and about going on leverage. Which is why when Alibaba went to $60, $70, I didn't go on leverage because I heard of stories of people jumping down the building.
Yeah.
I hear people like that. Do you think I dare to leverage until I 1.2, 1.5, 2 times? No, I don't. So in a way, how I try to position myself in the market was really influenced when I was younger and how they share all the different stories and his own experiences in the market. When he sees his portfolio down 50, 60%, and we're not talking about like my 5-digit portfolio. When it's in the 6 digits, few $100,000 down, what are you gonna do?
Yeah.
Like what Peter Lynch said, if it's at 12, you think it's cheap because it's at 37.
Yeah.
Then it goes to 5, 4, 3, what are you gonna do?
Yes.
So those kind of thoughts and experiences only come when you're in the market.
Yep.
Because when you're not, you only know to laugh at your friends. Oh, you're down, Alibaba is down 30, 40%. It's true story, by the way. A lot of my friends knows that I do YouTube, and yeah, it's good to be a spectator, but when you're not a player on the field, you don't know how it feels, and since you don't have the experience, if you start later, the longer you start, or the longer you take to start, the longer you take to acquire those kind of skill sets and temperament in that sense.
Definitely.
Yeah.
I think experience definitely humble us.
Right.
Yeah. So actually, I noticed one thing after having chat with you, right? Is that, my portfolio and your portfolio, we are like, so far, I think no overlap.
Right.
Thus far.
Right.
And one big difference is that you focus a lot more on the valuation side, and I focus a lot less on the valuation side, right?
Right.
So that's the reason of there's preference on different stock to invest. My question is that, let's say if you invest in a company by looking at a valuation that you think that is very attractive, right? Say Facebook, for example.
Right.
After the recent drop, definitely looks cheap, right?
Right.
My question is, if you buy it because of it is cheap now, does it mean that, let's say 6 months or 1 year down the road, let's say if the price just go up by, let's say 30 or 50%, is that means that it will be a sell for you and move on to another cheaper companies?
Okay.
Is that your plan? Or yeah.
Maybe I'll just explain, right? Because of the two levers that we are looking at, right? Valuation is just one aspect. We still need to look at the moat. So sometimes a lot of those standard discussion is whether this impact on the bottom line moat, right, or economic moat, or the competitive advantage, is it long term or short term in nature? If I believe in the execution of the management, and I think people usually discredit or don't give enough credit to the execution team or the management team.
Yep.
If they have a good track record of executing, why do you think this time will be different? Every time they like to say this time is different. This time is a Yahoo moment, this time is a Nokia moment. You need time to play out, you need time to let them prove to you that they're useless or they're the best in the world. So that's one part. In terms of economic moat, let's say talk about Facebook specifically, I don't think that, I think Mark Zuckerberg and his team's capital allocation skill is still decent. I would presume, or at least my baseline assumption is that if they think that the metaverse is a flop, they don't think they can continue pushing into this endeavor, they might stop and they might allocate lesser. So that's one part. And you look at the fundamental business now, look at the amount of free cash flow it's spitting out, $37 billion a year. Which company other than your other FANG stocks? And even Alibaba don't spit out so much free cash flow. Alibaba only spit out 20-something billion. Facebook is like near double of that. And the valuation is like what, 500 billion. When you look at Apple, it's at 2 trillion, Amazon is 1.5. But anyway, I think valuation only plays one part. We still need to look at the economic mode. So it's always a marrying of the two. But which one do you place more emphasis? I think I leave it up to you to decide. I think experience and your own investment philosophy and how you think about investments really matter a lot, and how comfortable you are. It just means that if it's a cheaper valuation, I have lower downside because essentially, if I have to buy something that's priced for perfection, there's a lot of execution risk and downside risk that I'm exposed to. So back to the question on when am I going to sell, right? I think there are a lot of factors that contribute to when you want to sell. Number one, I think everybody, those who actually do your own active stock picking, you know of your normal valuation models, right? Your DCF, you want to use price to sales, you start projecting out EPS and then you do a PE ratio, stuff like that. So all those, we all have our own valuation of particular companies. I believe, so personally, let's take Alibaba for example. I currently have a valuation, intrinsic value of Alibaba around 150 to 200. Those are based on extremely conservative estimate. So if I'm just going to give you a normal, let's say it mean reverts back up again in terms of PE, in terms of enterprise value, etc. Let's say it goes back to 220, 250. I have a viewer that also asked me, so are you going to sell? So it hits to 250. Am I going to exit the position? I don't think so. I think there are a few other factors that we need to look into. So now today I sell already, what am I going to do with the money? Keep in the bank? 0.05%? No, I don't think so. That being said, do I have another opportunity that I think is more lucrative or better than Alibaba in this case? And more importantly, do I understand the company? So do I understand the economic mode, its competitive advantage? Is it a good buy? Is it a good margin of safety enough for me to enter? All these are different questions on the external point of view. Then on the internal front, I'm sure assuming that we can really pinpoint objectively, Alibaba's intrinsic value is $250 today. Let's assume that's an assumption. So today it goes to 260. Am I going to sell? Probably not. Because unless there is a huge overvaluation, like suddenly Alibaba shoots back up to $400, $500, even breaking out, and the fundamentals of the company haven't catch up, I might consider. And in this case, I think I did share earlier in the video that I bought in Apple at 100, 110 because I thought it was lucrative. And even though despite I know that the moat of Apple is extremely strong, I did exit at 140, 150 because I found another opportunity and I happened to really like the risk reward Alibaba provide compared to Apple. So that was my thought decision process, my entire decision making process itself. There are a lot of factors. Of course, I can come up with a checklist, but sometimes even if you check 8 out of 10 boxes, I might not sell because of that one or two last criteria that didn't hit. There really isn't a science. Like I wouldn't say that once it hit 200, I'm going to sell everything. No, I don't think so. I'm also not in it to really just chase like a 20-30% return on my capital, then I'm going to exit. I think that's not my style as well. I think also in hindsight, right, it's always clear that, see, Alibaba dropped to 70. I told you not to buy. Why do you buy? It's not as clear when you are in that moment and when you have that specific amount of information. I think it really depends on a lot of factors, which is why I think in hindsight you always look back and say, clearly it's a falling knife. Why do you buy so early and stuff? I think it's not as clear when it's dropping. But that being said, like I said, I think the 3-step process is quite simple. Choose a good company, don't overpay, and then do nothing. That's
my favorite also.
Yeah, that's the entire process itself. In terms of constantly on the lookout, I think it's probably because I have an innate passion to constantly look at different business models and look at why I prefer some over the other. So if it's an ongoing process and I keep researching into different companies, inevitably I'm going to come to the next one that I like, or the next one that I might love even more that I didn't look out before. So like Manish Pabrai, right? He first looked at Alibaba, he loved it, he bought in already, then he realized that Tencent, he feels that Tencent is a more superior business. That's why he sold out and bought Tencent. I think in this case, I'm really just looking for opportunities, and I think people always like to give me the title that I'm a China bull, I'm a blind Xi Jinping supporter. No, I think I just look for opportunities, and I don't pledge allegiance to any country or any company. If I think it's the business is growing, or maybe if the price shoots up and the fundamentals are not catching up, I'll take some profits off the table and try to look for other opportunities as well. There are a lot of factors that go behind the decision-making process. It's a little bit more intuition, so I guess there really isn't a way that, I must tick 7 out of the 8 checkbox, then I'll exit the position. You are investing in a company, right, and you're putting your own capital. At the end of the day, you need to be comfortable, because only your good night's sleep is worth all this so-called financial independence and investing and stuff like that. So if you're doing things that you're not comfortable, even though I tell you Alibaba is the cheapest company in the world, if you can't sleep because you're scared of Xi Jinping, then sure, please don't invest in Chinese companies.
Thanks a lot for all the sharing. Really appreciate that. I think let's come to the closing questions. Do you have any tips for content creators that is like either new or just started out? Any tips?
I wanted to say first, I'm not anywhere any successful. I think probably when I hit Kelvin Learns Investing kind of level, then maybe I would consider myself a mini tad bit of successful. But I think I wanted to also thank everyone. I don't know, there are definitely a few overlap audiences, and I sometimes I also don't know why some of you watch me, but I guess there is certain form of value that you take away. In terms of like tips, quote unquote tips, I don't think whether I'm in a position, but maybe just a few sharings on what I learned throughout that 1 year of doing YouTube, right? Number one, I think you need to know how to differentiate. Like you said, because YouTube is a very complicated and a very, there's a lot of proposition. Everybody have their own proposition. It's exactly the same as running a business. When you have an investor mindset and then when you play YouTube, right, it's exactly the same. What's your differentiation factor and what's your economic mode? What you can do rather than other people cannot do. So in this case, maybe your knowledge is superior, maybe your entertainment value is superior, maybe how you present is superior. So all those are different factors, and you need to know how you're going to position yourself in the market. So in essence, it's a product market fit or creator market fit, if I can put it that way. So if you can find your vibe will essentially attract your tribe. So if you put off a certain vibe, if you're respectful, if you do a certain type of analysis, then you attract a certain degree and a certain type of people. And if you're more extreme, you put out a more extreme viewpoint, you'll also attract a certain degree of people because they like your way of and your style of presentation. So the first point, maybe it's a creator market fit, know what's your differentiation. I think number 2 on YouTube, also consistency is very important. I think people always have that burst of enthusiasm, right? Oh, today, let's go 1 month, I'm gonna upload every day. So 30 days I upload, then I burn out for the second month and then I don't upload anymore. Consistency is probably one of the most important factor. It doesn't guarantee you success, but without it, I think most of the creators that actually succeeded on the platform are usually consistent. They post once or twice a week and then they try to always improve yourself. And I like something that Kelvin always say. Kelvin said that every single video, you just look into how you can improve 1% better. Just 1%. Maybe you learn a little bit more about editing. Maybe you learn a bit more on how you can present better, how you can speak better. All this all adds up. 积少成多 in Chinese. So you slowly accumulate, and then sooner or later you will see that exponential
compounding.
Correct. So compounding, likewise in investing as well. Then maybe I think the last part is, even though it's nice, I won't say I'm famous as well. Okay. Now I think after 1 year, whether I'm recognized outside, I think I was only recognized once in school, once outside. So it's not like spectacularly famous, and one is a friend of a friend, so I think it's mutual connection, I guess. I think one thing also is, especially for those of you who are aspiring creators, I actually encourage you to do it. What Ali Abdaal said, I'm not sure whether you all know Ali Abdaal, but Ali Abdaal said, just post consistently for 1 week, once a week for 2 years, I think your life will change. You will get to know new opportunities, you'll get to know new people, new connections and stuff like that. Just do it for 2 years, your life will probably change because you meet new people. And I see actually currently there's a new wave of people coming up, especially in the finance space in Singapore. There are SMU students, NUS students, even NTU students as well that are coming up and sharing their opinions. I think it's all good. I actually all do subscribe to all of you. But I think one thing we need to always remember is in this world, it's not black and white. There's always gray areas, and you always have to know the pros and cons and evaluate accordingly. The chicken genius issue was a very big issue. Raising concerns on mental health, cyberbullying, things like that, right? Always hedge your downside and always know whether you can take it or not. Even though it's nice, you get to generate certain level of revenue, you get to gain some form of recognition, and people want to listen to you. You get that form of joy, and hey, people want to listen to me, like, you know, hey, people actually respect my opinion, and people spend that 5-10 minutes to watch into the video. But that being said, always know the downside and regulate yourself properly.
Yep.
I think likewise, like you see, the 3 points I gave all related to investing. The last point here is in terms of temperament and in terms of regulating your emotions, right? It's also a very important factor when you want to do something like that. Yep. Because don't forget, you're a quote-unquote public figure. By putting yourself out in the public, of course, you're going to attract a lot of positive energies, but don't forget, you're also going to expose yourself to a lot of negative energies as well. Try to give it a good thought. Maybe you can come up with a content strategy, maybe look for some advice and just go ahead and just start it out. Just consistently upload for 2 years and see what happens.
Yep.
And likewise, what's the most that can happen? Nobody watch.
Yeah.
But I think we always like to draw the line, right? So the best is you succeed, you earn a lot of money, and you're famous. Then the end, people think that, what am I going to do? Nobody's going to watch. But I would like to extend the curve. And one last part is, let's say you are half-half. So like myself, you have 10,000 subscribers. It's not a lot, but it's also not very little. And then you get a lot of hate. How are you going to handle those kind of opinions and how are you going to regulate your own emotions? So that's something that the not so glamorous side that people always don't talk about. So likewise, I think I wanted to take this opportunity and this event that happened to shed some light, and don't think that everything is, wow, this guy earned a lot of money, wow, this guy a lot of recognition, wow, people want to listen to him. I think, we try to look at both sides of the coins and be more rational in terms of our decision making. And I just think that the advice on being consistent and just trying out for 2 years, you don't have to commit. If you think once a week is too much, once per fortnight, it's also a plan. At least you're doing something and contributing to this flywheel. Yep. So that's about it.
Thanks a lot for the great tips.
Sure.
And I think the message to the audience is that I also observed that, you know, in the comment section, some of the videos we can see some negative comments, right? So just a last reminder to whoever watching, right? Not just this video, other videos that you watch, right? Please remember that all these content creators, we are just normal people. We are just voicing our opinions, right? Be nice with each other, and then here, you know, there's tension around the world, right? I think we all should strive to really make love, not war, right?
Right, make love, not war.
Yeah.
Yes.
So remember that. Okay, I think that's the end of this episode, and thank you so much.
Thanks for having me.
All right,
Bye-bye.
see you. Remember to subscribe. Bye bye.